Constellation Software is a serial acquirer that has massively outperformed the market in the past 5 years, up 289%. However, with Constellation's size and current valuation, investors are cautious of buying this high quality compounding company. But there is an alternative. This company is the parent company of Topicus, a business acquirer just like Constellation, with all their knowledge from the past, but 10 times smaller in market cap. Today we'll be diving into Topicus, why it might be a compounding machine of the future, and whether it's a buy at current levels. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. To begin with, this is a very complicated company, so please bear with me, I'll try to explain it as best I can. There's a company that's called Software Constellation. It's quite familiar to lots of people and it's done very well. They effectively are what we call a serial acquirer. They acquire businesses and then they use their free cash flow they generate from these businesses, because they don't grow that much, in order to buy new businesses. And effectively they create a whole new stream of revenue and free cash flow doing so. This way they've been able to compound at a phenomenal rate, increasing their share price by over 25,000%. However, more recently, the business has become quite large, at just over $160 billion market cap, and this affects their business model and acquiring new businesses. So they spun off two companies to replicate their success of the past, and one of those businesses is Topicus. So they're using all of their experiences and success and applying that to this $18 billion market cap company. So this is something that appeals to me, and I want to research into this business, and I'll tell you what I found. So Topicus, like Constellation, invests in acquiring what we call vertical market software businesses, which are payment processing and management companies mainly. And they tend to be quite dull and just not really remarkable on their own, with not much levels of growth. Now, what is actually quite specific to the software businesses that they acquire is that they are highly margined, and this means they produce a lot of cash, which helps Topicus and the likes of Constellation Software use that cash to buy other businesses. And this is actually a business model that has proved to be very effective for Constellation, and under Constellation's watch, Topicus could do the same. Now, the first thing I love about this company is their structure and incentives. So here we have, they laid out a very similar sort of structure to Constellation Software. There's no stock-based compensation at all. They simply don't offer it, but use a monetary and stock-based policy in order to incentivize their workers. And that's excellent from investors' point of view, because it doesn't really wear away or water down their shares, and effectively can create a better cash flow yield for everyone that invests in the company. Now, secondly, there is a bonus that they offer. This is effectively that their managers are directly linked to two metrics: return on invested capital and return on revenue growth. So effectively, if they do not achieve these two things to satisfactory target levels, then they don't get their bonus, which is a massive incentive that I think is actually something that is pretty useful for other businesses like tech. So even if they achieve this bonus, it comes with strings attached, and they have to use 75% of that bonus to buy into Topicus stock. And effectively, they cannot sell Topicus stock for the next 4 years. This is something that Constellation does, and now Topicus is doing the same. And this is something that could motivate tech-based companies as well in the past, if you ask me. Now, the next thing I found, which is very interesting for shareholders and massively beneficial in my opinion, is that Constellation has a huge stake in Topicus. As you would expect, they have around a 29% stake in the business. This is a controlling voting rights business share as well, at just over 50%. So everything they do has to go through Constellation Software, and Constellation Software has already proved they can compound massively into the future. Now, they own it through a subsidiary called Jodrey's Group, I believe it's called. So there's no other entity that can come in and drastically change the culture of Topicus and move it away from the goals Constellation has set out for them. And to me, this is excellent, because the guidance from a company that has made an acquiring business like the likes of Constellation Software is invaluable. And another thing that they sort of share is their management team. They have the same CSU management team, which is heavily involved in managing Topicus. The Chief Financial Officer, Steve Relia, is the same for both Constellation and Topicus. And many directors in Topicus have come directly from Constellation Software and still work at Constellation in some capacity. Here we have a tweet from Stephen Framp which covers Topicus' subsequent events, and he's actually talked about the fact that in 2025 so far, as of February, this company has made a massive amount of investment in acquisitions. Judging by this, for around about 675 million euros, which is close to about more than their entire investment in acquisitions since they became a publicly traded company. So in just 1 year, because they've gone international, they're now making a record amount of acquisitions. And this is something that is massively hopeful for this year's and future free cash flows. Basically, this is effectively Constellation 2.0 really. They have an excellent management team that is likely to make the sound decisions that Constellation would have made, but just 10 years ago when they were so much smaller. And if it's run by like-minded people with the same culture and incentives, I could see this being a recipe for a compounding machine. So in fact, obviously Constellation often lends money to Topicus to acquire the businesses that they have laid out as being excellent acquirers. So they're heavily involved with the sort of acquiring process, and I don't really think it gets much similar in terms of business models than this. This is effectively the same company just 10 years ago really. And I think that this pretty much sums up, if you feel like you missed the boat on Constellation, you could be getting a compounding machine in Topicus. Now if we switch it over to their balance sheet, they're growing revenues very fast at around 18%, but this doesn't include organic growth as well. So they have more organic growth than Constellation Software because they're growing fast. Their businesses that they've acquired are higher quality and they're growing quicker. So right now, those businesses organically are growing around about 6%, but they have been growing as fast as 8% in the past. Meanwhile, Constellation Software, being a lot bigger, their organic growth sits closer to about 1% now. So you're getting a little bit of organic growth in the mix as well, which is, I think, heavily important. It's something that I quite like in my businesses. I prefer organic free cash flow growth and not serial acquirers. However, I do think that Topicus could be the exception. Now we need to ask ourselves, is this share price a good price to pay for this company? Around $140 per share or so. Well, currently, this actually means it's trading for a price to operating cash flow supposedly of 20 times. In reality, the number is a bit higher. This is mainly because their basic share count is different from their diluted share count. Their diluted shares is considerably higher. And I think the main thing that we want to do is not be unpredictable into the future. So we want to consider those diluted shares, which means this company is actually trading for over 30 times price to operating cash flow, which is quite high. And we want to know that we're getting good value for that. If we use this on our DCF, we can try to see if this is trading at a good valuation now. And we're going to start off using operating cash flow because I think it's the best metric with a 5-year time horizon because it's harder to predict after that point. And we use a metric growth rate that I believe is still more than possible for this business at 20%. The reason for that is because they've done the most acquisitions they've done in years, more recently because they've started growing internationally. So I do believe that this number will likely to be well below what it increases over the next year. It's probably going to be over 50% in operating cash flow next year. And then shares outstanding, we reduce that down because they're unlikely to issue any more shares. And then we have a dividend growth rate that is low, and then we do a price ratio of around about, I want to say around about 20, because I do believe that this is on basic shares, not diluted shares. Their diluted shares would make this price operating cash flow to be around about 34 times. But I can't actually use that at the moment, so we will be using their basic share count. And this returns a fair value of $200 per share and a CAGR over the next, say, 5 years of around 18%. at their current share price of around $138 per share. So I think this is massively attractive for this business, and even if we was on the more conservative side, say around about 18%, and say they have a margin in contraction, say around about 18%, I still believe that this business would actually return around about 14% CAGR over the next 5 years. So I do believe it's going to be a compounder for the future. I'm very interested in owning this one in the future, and I'm going to continue with my research. But what do you guys think? Do you like this business? Let me know down below. And as always, thanks for watching. I appreciate it, and I'll catch you in the next one.